Okay, my second market outlook from Costa Rica. I have changed rooms. So the hum behind me is gone because I'm out of the AV room into another room that has no AV equipment, but it has a lack of furniture in it. So I brought some furniture in, hung some things on the wall. So a little bit more work to get the sound dampening in so that the voice doesn't echo. Let's have a look at where we are. And rates gave back a little last week, mostly on Friday. Pretty much gave it all back on Friday on the jobs report. But when we do a little bit of adjusting on the jobs report for the revisions to September and adjusting for the UAW strike, and then thinking about the adjustments to levels, not just seasonality, but to levels, I don't know why the bond market would not have fallen in love with the jobs report, but we'll see it when we get to it. Money market rates very well behaved in a tight range here. The 2-year to the 10-year all increased a little bit, mostly on the 2-year, because the 2-year tends to import some expectation of monetary policy, and it gave back the most. The 10-year, call it unchanged week over week, but the 20 and the 30 dropped in yield, so TLT did week over week have a positive performance. But going into Friday's job report, TLT was pushing 96 at one point in pre-market, so that's a shame that we lost that much. Looking at slopes, all of them inverted except the 3-month to the 10-year, pretty much flat. The 2 to the 10, the capital market inversion is at negative 48 from negative 34. The Canadian's still sitting at negative 78. Bank of Canada met this past week, no change, and we're going to read their release. One line is fairly important in there, and then there's a paragraph saying we stand ready to do more if necessary. You have to say that. Going to the 3-month to the 10-year, the money market to capital market inversion, negative 121 in the U.S., negative 165 in Canada. The 2 to the 10 in the U.S., 515 days now, and the 3-month to the 10-year, more than a year. There has never been a situation in which you had an inversion, a triple-digit inversion of the 3-month to the 10-year for this period of time where you have not had a recession. Now, mind you, you got a sample size less than 10 on this one. It's not like we have 100 observations. Sample size less than 10. It is possible to take a coin and flip 7 heads in a row and say, oh, well, it must be a coin that only flips heads. I've never seen a tails, but it's such a small sample. Statistically, it is possible to escape a recession, that this indicator had just too small a sample, but it is worth noting, given the depth, 3 digits, and the duration, 402 days, the combination of those two, we've never escaped a recession. Another indicator is the leading indicators. 18 months now they've been in contraction. Never has the economy escaped a recession from that either. So the soft landing argument is kind of, you can flip a coin on that one. You could almost see that it kind of looks like we're doing that, but at the same time, I think the pathway's rather narrow. I'll explain that a little later. The balance sheet runoff continues. SOMA down 30.36 billion, sitting at 7.148 trillion. I think we're a couple of months away from a 6 handle on this one. The balance sheet itself down 58.76. So considering the SOMA was down 30, you still had net balance sheet runoff of another 28.4 billion on top of the 30.36. Money market funds, retail up 18.5 billion, institution up 43.15. Another big week, increased by 61.65. So I thought, you see this? Well, reverse repo is going to be down. Nope, reverse repo usage was actually up. So more money into the reverse repo and another 61 billion into money markets, which sets up a bit of a question here as to, that doesn't line up. Not that it's so odd that it requires, deep thinking. It's just, what's going on here? Is this a sign of something? Okay, this is a big week for central banks. Three big ones. You have the FOMC on Wednesday, followed by Thursday morning two more, the Bank of England and the ECB. And I'm not too sure what to think about the Bank of England, but ECB seems like it's going to be a zero based on some chatter coming out of one of the officials from the ECB and the state of their GDP. Much like Canada, we have negative GDP in the third quarter. Bank of Canada, no move whatsoever, and we'll read their statement shortly. I think ECB is there. I believe the Fed has been there for some time. I don't see any move coming from them. 98.4% on zero. Last week, 98.8. These changes are nothing more than just positioning in the futures. I don't think there's any information content in there. For all intents and purposes, I basically see this as 100% and 0%. I think the market is there. This is just based on positioning. You're going to get maybe some slippage where it won't be exactly 100%, but for all practical purposes, it's 100%. Going out to June, very little movement here, but there has been some movement. At least one rate cut, 98.4 down to 94.8. Small little change, but I don't think that there's a wholesale shift in the market that rate cuts aren't going to occur. With this meeting, we get a new summary of economic projections, a new dot plot, and a new terminal rate for 2024. And we'll see if that's different than what the market is currently pricing in. The market's currently pricing in a little over 100 basis points, somewhere between 4 and 5. Last week, it seemed like it was 5 firmly. Now it's somewhere between 4 and 5. We'll see if they sort of agree with that. So we'll get that. I think that's the more important thing on Wednesday. I don't think the decision is really that important. I think it's going to be a no surprise, zero move, and the SEP will have any kind of movement in the market will come from the SEP, and then of course from the press conference. CPI in 2 days, and we get that Tuesday morning, so the FOMC will have that for the Wednesday meeting. That's probably the only big risk factor sitting in front of the decision. And you have PPI on Wednesday morning. For us, I shouldn't say us, I'm not in Canada anymore. For you guys left in Canada, Meldrum, 1:40 p.m. on a Friday. New York Fed publishes the effective federal funds rate, still sitting at 5.33. The 12-month lag is still 150 basis points. And reverse repo increased by $52 billion from the 1st to the 8th. If it were the end of a quarter, you could see an increase, especially going into the end of this year. There'll be an increase in the reverse repo. But week over week, like this, to have an increase and to have an increase in money market funds as well. Again, there's that question mark. I did expect to see a decrease, and it was an increase at 5.3%. There are T-bills out to the 6 month available with yields higher than 5.3%. Okay, let's look at the Bank of Canada statement. It's short. Let's just read it. Bank of Canada today held its target for the overnight rate at 5%. Bank rate at 5.25%, deposit rate at 5%. Bank is continuing its policy of quantitative tightening. Global economy continues to slow, and inflation has eased further. In the United States, growth has been stronger than expected, led by robust consumer spending, but is likely to weaken in the months ahead as past policy rate increases work their way through the economy. Growth in the euro area has weakened, and combined with lower energy prices, this has reduced inflationary pressures. Oil prices are about $10 per barrel lower than was assumed in the October monetary policy report. Financial conditions have also eased, with long-term interest rates unwinding some of the sharp increases seen earlier in the autumn. The US dollar has weakened against most currencies, including Canada's. Not that much. I don't know if I do a victory lap on that. Not that much. In Canada, economic growth stalled through the middle quarters of 2023. Real GDP contracted at a rate of 1.1% in the third quarter, following growth of 1.4% in the second quarter. Higher interest rates are clearly restraining spending. Consumption growth in the last 2 quarters was close to zero, and business investment has been volatile but essentially flat over the past year. Exports and inventory adjustments subtracted from GDP growth in the 3rd quarter, while government spending and new home construction provided a boost. The labor market continues to ease. Job creation has been slower than labor force growth, which is what you need for an easing, right? Job vacancies have declined further, and the unemployment rate has risen modestly. Even so, wages are still rising 4 to 5%. This next sentence says it all. Overall, these data and indicators for the 4th quarter suggest the economy is no longer in excess demand. That's it. That sentence right there, the economy is no longer in excess demand. And if it's not in excess demand, any inflationary pressure cannot be demand-driven. And you can't cure supply-driven inflation by raising rates because you'll constrain supply even more. They're done. Let's read the last 2 paragraphs here. The slowdown in the economy is reducing inflationary pressures in a broadening range of goods and services prices. Combined with the drop in gasoline prices, this contributed to the easing of CPI inflation at 3.1% in October. However, shelter price inflation has picked up, reflecting faster growth in rent and other housing costs, along with the continued contribution from elevated mortgage interest costs. In recent months, the bank's preferred measures of core inflation have been around 3.5% to 4%, with the October data coming in towards the lower end of this range. With further signs that monetary policy is moderating spending and relieving pricing pressure, Governing Council decided to hold the policy rate at 5% and to continue to normalize the bank's balance sheet. So they are still tightening if you consider quantitative tightening in reducing the money supply as a tightening mechanism. They are still tightening. Much as the Fed is still tightening. Governing Council is still concerned about risks to the outlook for inflation and remains prepared to raise the policy rate further if needed. Now, you can say that at any time because that is your mandate. You can have no inflation. You can make a decision, we're not raising our rates, but you could say, but, remember, our mandate is inflation. We stand ready to raise this rate if inflation shows up. So you can say that at any time. I think the more powerful sentence in here was the economy is no longer in excess demand. This is something you have to say, number one, because it is your mandate. Number two is you can't let the market throw a party and ruin everything for you. You have to keep the market in place. Still concerned about the risks to the outlook for inflation, remains prepared to raise the policy rate further if needed. Governing Council wants to see further and sustained easing in core inflation and continues to focus on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. The bank remains resolute in its commitment to restoring price stability for Canadians. Real rates, well behaved. Not a lot of volatility here. An increase of 11 on the 5 and a drop of 7 all the way to the 30. 11, then 6, then 2, then -4, then -7. So something like this with this being the 0 line. And of course your break-even rates all well behaved as well. Not much to see here. The Fed funds futures seem to be pricing out at least one rate cut. Last week it looked like it was firmly 5. Now it's 4, firmly 4, and maybe a 5th. Last week was, there's a 5th, and now it's, I don't know, but still 4. The January futures are bottoming out in January, 5.33, basically where the effective federal funds rate is. Then a drop of 39 by the time you get to the end of June, or at least the June meeting. So somewhere between the end of January and the end of June, the market is expecting one rate cut firmly and somewhat maybe even odds of a second rate cut, but at least one rate cut firmly. And then from June to September, this is Q3 within here, you got another 30 basis points. So firmly another rate cut. Maybe if you spill over the 19 into here, you get 24. The sum of these two and kind of hint at maybe there's 3 rate cuts in there. Looking at SOFR, 110 basis point drop between December of 24 and December of 23. So attribute the 39 to Q2, attribute the 30 to Q3. You got 41 sitting in Q4. I think you probably have one rate cut. At least this is what it's looking at, sometime in Q2. By the end of June, you're going to get a rate cut. Usually it's about 9 months after the hiking cycle is done, so that the Fed hikes rates and then they hold it steady and then they begin to cut rates. It's usually about 9 months. July was the last rate hike. So if we think about it that way, 9 months is March. Going up to 10, 11, 12 months, you're getting into April, May, June. So it's not unreasonable, even from an empirical perspective, meaning looking at history, it's not unreasonable to say, yeah, we can expect one rate cut if history is any guide. One rate cut. Q3, 1 to 2. I'm just saying, well, I don't think you're going to get 2 by the end of June. Let's take the extra basis points and throw them into the third quarter. 1 to 2, and then fourth quarter, well, 1 to 2. So we're somewhere around 4 with 110 basis points. Maybe 5, but somewhere around 4. TLT did squeak out a good week, up 1.67. SPX up 0.21, printing another 52-week high. IVP pretty much the same. No changes here. This is the unfortunate day. There is 96 over here, and you could see we were bumping up against 96. It looked like it wanted to break 96. It had the jobs report and it said, oh, we don't like that jobs report. But again, if we do a few adjustments for the revisions and for the UAW, the good news that we think, or the strong jobs news the market think it saw in that jobs report, really isn't that strong anymore. So let's just get to that now. Usually after that last screen, I go into mortgages and housing, and then I go into exploring other things. But let's just do the jobs report right now. Household added 747, a participation rate of 62.8, which is up 0.1 from 62.7. Unemployment rate 3.7, down from 3.9. Full-time jobs added 347, part-time 339, because of course we're trying to recover the 747. The establishment only reported 199, which is what the market pays attention to. 150 private, 49 government. And private, it breaks it out into manufacturing. And in manufacturing, we do have motor vehicles and parts. October, a drop of 32. November, an increase of 30. That's the UAW strike. So we'll make an adjustment for that. Also, this number reported here is seasonally adjusted, but it is not level adjusted. What does that mean? Every November, December, the economy will add jobs because Christmas is coming up. So there's usually a big ramp up in jobs for different categories, retail especially, airlines. It's a big travel season during that period of time, warehousing, distribution, lots of jobs are added. So they're seasonally adjusted because if you add 1 million jobs every December, you can't just have a data series that says, hey, we added 1 million jobs. You have to say, no, the economy normally adds 1 million jobs. If we're looking at job creation, only if we added 1.1 million would we say, we have more jobs than last year. So you have to seasonally adjust. However, it's not level adjusted. So the unemployment rate is extremely low. And in the US, there is a very high marginal propensity to consume, which means the Christmas season this year will entail more spending than a Christmas season that might have had an unemployment rate of 4.3%. So at lower levels of unemployment, at higher levels of employment, you would have a larger seasonal hiring. And if you only affect for seasonality and not for levels, it will appear that the economy is adding more jobs than it normally would given the season that you're in, but you have to adjust for levels as well. This is not level adjusted. So let's look at what else we had in the establishment survey. Average working hours, 34.4 was up 0.1 from 34.3. Average hourly earnings was $34.10. On an annualized basis, that's up 4.32%. But keep in mind our third quarter revisions to productivity and unit labor cost. Productivity was up 5.2%. and this is up 4.32%. And because of that, you should expect that you have negative unit labor costs, negative 1.2, and it should be very close to the difference between these two. The difference between these two is 1.12. Unit labor costs was negative 1.2, or I should say, depending on how you're subtracting it, 4.32 minus productivity is negative. So that average hourly earnings, if you want to use that as a gauge of wage inflation, I don't like using it as a gauge of wage inflation because it is affected by the mix of jobs, not just the pay, but the mix of jobs. If you use that as your measure of wage inflation, you have to combine it with productivity. You have to look at your unit labor costs. If your average hourly earnings, or whatever measure you use to measure wage inflation, is below productivity growth, that is deflationary, not inflationary. And that's how you can justify paying your staff more. Is you could say, I would love to pay you 20% more if we can get revenues up 30%. I'll pay you 20% more because you'll still end up in a better place. You got to give staff upside. That's what productivity does. You can justify paying your staff 20% more each year if you're generating 30% more volume, right? If your productivity increases for the same number of people you have and you're generating more output, you can pay them more and still increase your earnings. That's the whole concept here. Why that was ignored, why focus on just the 4.32 and not celebrate the fact that, wait a minute though, productivity is way up. Who cares about this? This is great for aggregate demand in terms of the consumer, the strength of the consumer. That's great. Well, with aggregate demand comes inflation. Not when you have negative unit labor costs. I mean, there's your Goldilocks scenario. There's your soft landing story in there, and the market didn't like it. From the household survey, lesson high school added 130, high school 153, lesson BA 196, and BA plus down 68. This is in keeping with many of the companies who have had wage increases because of unions. GM being the latest one to sort of announce this, that they are introducing cost-cutting measures to offset the increase in union by decreasing management staffing levels. So we would expect to see this, the increase across all these three levels. Typically, the seasonality effect usually adds jobs at the lower end of the spectrum in terms of skill levels. So we would expect to see that going into November. And then in the January report, we should see the same thing, that during the course of December, more jobs were added there. When we get the February report for January, we'll see a reversal in these ones here. Let's do some revisions here. September was revised negative 35, came in at 297, down to 262. And the September report, we got that in October. Now, if you remember that set up a sell-off in bonds, and the bear steepener, or the sell-off, really accelerated at that point because it's like, oh, we got a strong job market, rates are going higher. And that's when we had Jamie Dimon saying, we should be prepared for a 6% 10-year, which, we got to 5%, and that was about it. So you have to think, well, what if 262 came out instead of 297? We might have had a slightly different market. We might have had a slightly different bond market, but this revision was ignored, 35. So let's just see, and what we're going to do is we're going to adjust for the UAW strike here as well. September 262, October 182, because it came out at 150. Well, let's add them back. That would have made 182. And take the 30 out of the 199, you're at 169. 262, drop to 182, drop to 169. Because the strike was not economy related. It was not a function of the economy. You could call that an exogenous event. It was not part of the economy. So had the union contract not ended, that strike would not have ended. This would have been the trend. This trade-off wouldn't have happened. So you do have to adjust for that because it is not economy related. And we do have to think about that revision. 262 in September drops to 182 in October, drops to 169 in November. Yes, you have 4.32 here, but you got 5.2 here, creating negative unit labor costs. What's not to like? Look at JOLTS. 8.73 million. The expectation, or sorry, last month, sorry, not the expectation. Last month was 9.35 million, down 600,000, 15%. 15% reduction in 1 month in the number of job openings. And the quits rate, 3.646 down to 3.628, still in the 3.6 range, meaning, yeah, okay, well, you still have the opportunity to get better pay somewhere else, take it. But it is coming down. So this number, these revisions here, this scenario over here, and the fact that, hey, listen, we didn't level adjust, we've only seasonally adjusted. And with this low level of unemployment, it does set up probably a more robust consumer spending season, which will be reversed in January. I don't know why the bond market was so negative on this one. Mortgage rates still coming down 6 weeks in a row now, 7.03, threatening a 6 handle here, down 19 basis points. Over the same period, Thursday over Thursday, the 10-year dropped 23, so the spread increased by 4, 289. I still think MBS has a very wide spread right now as well. I still think agency MBS is just a screaming buy right now. If you're looking at fixed income, you can buy treasuries, or you can grab another. I think the spread right now on MBS is well over 200 basis points. You can grab another spread on top of the 10-year by going into MBS. Now, mind you, every payment is principal and interest, so as rates drop, you have that reinvestment risk that, well, now I got to reinvest some of my principal at lower and lower rates, whereas with the 10-year, you'd get that yield all the way through. But, I mean, I just can't see why I wouldn't want to grab some. I can't right now, unfortunately, but, to me, I think it's a screaming buy. Agency and Annaly both pulled back. Arbor still advancing 1.56%, which is nice. Look at the home builders. Look at the drop in mortgage rates. Look what it did for the home builders. Mortgage applications up again, 2.8%. I think that's 7 weeks running now that it is up. And look at these numbers: 5.86%, 5.8, 5.1, 5.7. And look at this little guy. And I saw the price at 139, and I said, "Oh, wow." There must have been some event during the week, so I looked at just the chart for the week, and no, it was just a move up every single day. There was no gap up. It wasn't like I was looking at the chart and then one day it just started up here. Then you have to explain that gap, but there was no gap up. It's just a short float stock with huge volatility. Look at that in 1 week. My God, I think the next time this guy pulls back, next time you have a massive sell-off in the housing stocks, if the fundamental problem of housing inventory isn't solved, I think I got to add some shares of this guy just for the roller coaster ride. Look at that thing, 46%. Nothing to see in corporate spreads at all. This is from SIFMA. This is, since we have the November data, here it is here in terms of issuance. Investment grade, 107.8 billion was issued. Last November, 107.6 billion was issued, basically the same. It was issued at 5.19. The average of all this came in at 5.19. I shouldn't say the average of all that. The average investment grade, if you look at an index of investment grade, the average yield was 5.19, here 5.49, 30 basis points higher. It's in high yield. That's rather interesting. Here you had 25.6 billion issuance. Last November you had 10.4. The high yield index sitting at 8.33% yield. This is not the spread, right? This is just the yield. 8.33. This year 8.05. So even though year over year you had another 150 basis points increase on the effective federal funds rate, the high yield index went from 8.33 to 8.05, actually lower because of the spread. Remember, it hit a high of 1,289. We're sitting at 960 points. Oh, sorry, that's triple C. Let me back that out. Let's get to our high yield. Here it is, 5.99. We're sitting at 3.77, under 400, under 500. A high yield CDS has a fixed rate of 5% or 500 basis points. This is 377. But issuance, year-to-date issuance for 2023 is up 3.8% over 2022. Okay, worth having a look at GM. Here was the business update that they gave, and since then they have been moving up because of their share repurchase. Somebody had asked me, how did you get to the price you got to? I divided by 3 and multiplied by 4. It's because they have a $40 billion market cap. You're buying $10 billion back, which is 25% of your stock. So that means the current price is represented. You could say, well, that's 3/4 of what it should be. So you divide the current price by 3 and multiply by 4 to see what it should be. I'll show you another way to do it down here. I'll be putting out a video probably New Year's Day of my best ideas for 2024 without having to forecast too much. If on January 1st I had to make 5 or 6 decisions and not touch it all year long, what would I do? This is one of my ideas. Sell puts at the $38 to $39 strike each month and roll them forward. So I'd be selling at the 38 to 39 strike. You'd get the intrinsic value plus some time value, and then the next month you roll them forward. So if they keep moving up, you're getting all the move, right? All the move. It's not like you're selling puts below and and getting 80 cents and it moves up $1.20, and then selling for 80 cents and it moves up $1.20. You're getting all the move on the way up. So I'd be selling the in the money puts and then just rolling them forward each month. Because I do have a target range in there based purely on the reduction of the number of shares. Look at their book value per share. If you take average shareholder equity Q2, Q3 and divide it by the number of shares outstanding, you get to 53.25. And they were sitting before the buyback somewhere just below $29. And yeah, so of course, Mary Barra says we are disappointed with the performance of our share price. Yeah, no kidding. Now, I didn't adjust the book value per share for certain things, and some things you would adjust for. You would say, well, some of these assets I'm not really going to include, and some of these liabilities I'm not really going to include. You would adjust it, and then if you want to adjust it for things like goodwill, saying, I don't really like that goodwill thing, and you want to get to the tangible book value per share, you would make adjustments. But just as a starting point, 53.25 on the book value per share. November 28th, it had a market cap of $39.6094 billion, which was a closing price. This was the closing price before the day they announced their buyback. 2887 times the share count, you get to 39.604. The buyback is 10 billion, which is 25.25% of its market cap. It is buying back that many shares. Now, this is going to be a little bit of a mathematical issue here because you're buying back 10 billion based on a market cap of 39.6. Let's call it 39.61. As this price increases, as soon as you announce it, the price increases, multiplying it by the same shares, your market cap increases. So the 10 billion actually represents less and less of a percentage as we keep going, but it's an accelerated buyback, and they were planning on hitting the ground running. In other words, instituting it almost immediately. But as the price goes up, they're buying back shares at a higher and higher price. So it's not as if they're reducing the share count by 25%. And they're just reducing the share total that they buy back by 10 billion, which might end up representing only 17% of the float as the price moves up. So as the price moves up, it becomes, less and less attractive in terms of its full impact had they been able to buy back 10 billion all at 28.87. From level 2 corporate finance for CFA, you'll recognize the beauty of this. They're buying back stock, and right now it's sitting at 33.80. Book value per share is 53.25. We know that they can increase the value of the company if they can buy back their stock at a price lower than its book value per share. So right now, this is a good thing. Now, I'm assuming the same market cap. I'm assuming the market cap will not move. That after they buy back the shares, the market's still going to look at GM and go, you're only worth 40 billion. Doesn't matter to me. Your franchise and your brands and your business model still only worth 40 billion. Let's make that assumption. So if we take the original price, 28.87 before the announcement, and divide it by, we have a buyback, just assuming 25% of the stock, 1 minus 0.2525 gets us to 38.62 a share. That is saying that even with the buyback, the market's not going to see any extra value. There will be no emergent property associated with the valuation of GM just because you're buying back shares. The market's still not going to get excited about it. 38.62, which is why I'm saying $38 to $39 puts, because just the buyback can push it to that territory. Now, there may be more buybacks next year. There may be more depending on how aggressive they want to get. They may see returning money to shareholders as their viable option for adding value to the shares because the market's not doing it. Management's compensation, most often the biggest part of their compensation is tied to the share price. So if the market is not going to reward them for the cash flows that they're generating, for the EBIT that they're generating, then the business itself is going to have to do it. And it makes good business sense from just a rational point of view that if you can buy back your shares at $33.80 where they are now, and book value per share, never mind the tangible, but book value per share is $53.25, it makes sense. Even adjusting and getting to tangible book value per share, you're still above $33.80. You're still much above $33.80. So while I don't think that I'm interested in a company with a union coming off a big victory, that's probably not going to stop. It's probably, if GM is successful, the union will be back demanding more of the investors' take instead of just buying stock themselves and getting the investors' take. No, they won't do that. They want some of your pile. I wouldn't be interested in this. I'm interested in it purely from the structural and the technical perspective here of the share buyback. It is going to boost the price. So I don't know that I would want to own it outright as a business, but from a share buyback perspective and potentially maybe more, then yeah, I think the 38 to the 39 puts, the January puts, and then when they expire, sell the February puts and roll them over to the March puts. So even if you sell the put for, let's say you get $7 for the January put, and you have to cover at $5, and you sell the February's for $6.50, and you have to cover at $4.50. The thing is, you're short at $7, you're covering at $5. You're short at $6.50, you're covering at $4.50. I'm giving you some examples here, but you don't have to have the put go to zero. You know, if you sell it for $7 and cover for $5, you still made $2 of it. But selling the 33 puts for 80 cents to me seems, I won't get 100% of the move up. By selling in the money puts, I will get 100% of the move up, plus a whole bunch of little time values associated with it as well. Okay, we have another 52-week high on the index and on SPY, 460.59. Remember the July high here was 457.85. We were above it last week and also a new high this week. 19.6 on the forward multiple, 19.54 last week, closing SPX 46.04. 4-quarter operating earnings forward 236.26, IBES 233.66, S&P Global, so I add them, divide by 2, I just take an average, 233.06 up to 233.66. Another week of the revision going up, and 236.41 to 236.26, kind of the other way around. So one moving up, one moving down, sort of mixed. 19.6 on the forward. Tuesday we get CPI. Wednesday we get the Fed. Then you have tax loss selling into the end of the year, which, you know, I don't know that there'll be too much of that going on. And then what occurred to me this week, because I was thinking about my residency here, I don't have residency yet. I don't think I'll have residency till sometime in February or March, which means on January 1st, I'm still a Canadian. So I was thinking, well, that means that I can still contribute to my TFSA, and I can contribute to my RRP, my Registered Retirement Plan. I can still make the contributions for the year because I'm still a Canadian. And then it occurred to me, you know what? How many people would be doing that? How many people, once you get into January, start making their contributions into the retirement accounts, or the registered accounts, I should say, in both Canada and the US. So maybe going into January, there might still be some support because money is coming into these accounts that might right now be sitting in money market funds. So it could be that money is moving into money market funds in anticipation that, you know what I'm going to do in January, let's put this into my registered accounts, but I can't make the deposit until January, and I don't want to put it in the market and risk it disappearing. Let me put it somewhere safe. So it could be in money market funds until January, where they can then say, okay, let's move it into these accounts where I can then buy longer term bonds, because why wouldn't you? So the bond market might have some support going into January, because that's what I plan to do. And I thought, well, if I'm going to do it, I can't be the only one doing it, because January 1st is when the floodgates open to be able to contribute. So maybe January might have some inflows out of money market funds into the long end of the curve, into long bonds, or into the equity market. So January might be supportive there. We don't have much for earnings this week. Adobe on Wednesday, and I believe it will start with the words AI, and AI will be mentioned 17 times, and it will probably end with the word AI. They're probably going to continue to ride that one. And you have Costco Thursday morning. So you have CPI Tuesday morning, PPI Wednesday morning, the Fed Wednesday afternoon, Wednesday after the close, Adobe. In the morning, you have Costco, the Bank of England, and the ECB. If we can get through the Fed and the inflation data next week, if we get through that unscathed, I think we're okay till the end of the year. And then January, if I'm right on the money just sort of holding back before it floods into these registered accounts, then maybe January could be a good month as well. Implied volatility, basically unchanged. There it is there. So it's not as if there's a really great selling or buying opportunity sitting in the options. It's the same as it was last week. And there we are. Be aware, you got 3 big central banks next week. The one for us, I think the 2 big things for us are Tuesday morning. If we can sneak past CPI, if CPI looks good for Tuesday morning, all we got is the Fed, and I think the thing for the Fed more than anything is going to be the summary of economic projections. There is a press conference, so I will be putting a video out later that night, reviewing the press conference. You know, I go through all the questions and the answers, and then we tend to ignore some of the people like NPR. We just say blah blah blah, whatever NPR asks, blah blah blah. It's never important. You can expect that Wednesday night, and that's it.